you're right. There are companies that have already and will cut their dividends. But when we, like you said, when we crunch the numbers, what was interesting to me is that the sectors that contribute the most to the total dividend yield of the S&P 500 are sectors that generally have clean balance sheets. So, for example, if you add up the dividends from tech and financials, that makes up about a third of the S&P 500's dividend yield. Then when you look at tech and financials, these are two sectors that have fortress balance sheets, very low payout ratio, so they have a lot of cushion. So even if they lost, 60% of their earnings, they could maintain that dividend given how low their payout ratio is. So I think that there are cases where, there are companies that are distressed and it would behoove them to cut their dividends. But I think for the bulk of yield in the S&P 500, it actually looks sustainable to me, especially if we are coming close to the end of what looks like a point of, maybe not full economic activity, but some signs that things are getting better rather than worse. So I think these are all positives for the market. I mean, the areas that I worry about the most are energy, which you just talked about. So I think that oil price volatility is still relatively intense, and that could pose risk to energy company dividends. Consumer stocks also look to have potentially risky dividends if if we don't see a kind of an end to this stay-at-home period. And then within small caps, I think there are a lot of companies that have taken on excess leverage that are potentially more at risk than larger companies. So there are pockets of risk, but I don't think it's really kind of the critical mass of dividends within the S&P 500.